Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest, Landon Swan. He's a co-founder at Likefolio. Welcome back to the show, Landon.
Thank you. Good to be here. Hey, Tom. Hey, Kevin.
All right. Deckers Outdoors. UGG brands, I get it. I wear a pair around the office all the time. The slippers on a daily basis. The Hoka brands, I'm maybe questionable on that a little bit, but it seems like the momentum is continuing in this name. Are they taking market share? Do you guys have the data that kind of backs up the 36% gain that we've seen so far this year?
Yeah, they're on a tear this year. Almost 2x from a year ago, but they're basically sideways since July, and they're actually kind of on the lower end of the range. So I think that even though they're up significantly, since the stock has cooled, maybe expectations have cooled a little bit. There may be room for a small beat here, but they did great on their last report. Their revenue was up 22%, earnings per share were up 87%, their margins were up 5%. They crushed it last quarter. They did a really good job, but the stock is basically kind of retraced. So I think that the market kind of wants to see what's next, and are they justifying this pretty high PE ratio? It's nearly 30. It's much higher than the industry average, and so I think investors want to see if this growth can continue. And as you talked about, those two brands, that's basically the whole company. Hoka is 2/3 of the revenue. UGG is 27% of the revenue, so that leaves like 5 or 6% for the other brands. But I think this is a company that understands life cycles of brands. And UGG boots were all the rage 10 years ago, and then they went out of favor, and now they're back. Hoka is just getting started. They've got a few other brands. Tiva and Sanuk, I believe is how you pronounce it, are kind of on the decline. They just sold that one. Another one's a Kula Brew, something like that. I can't pronounce it, but that one's going up, but it's only 0.5% of the market of their revenue. But I think that it just kind of shows that they know what's next. They know that brands have this life cycle, so they're always looking to get the next cool thing. It's amazing, frankly, that UGG came back. That you don't see that too often, but Hoka's up about 30% on a year-over-year basis. UGG's up about 14%, and again, that's 95% of their revenue. So we like to see that. There's a little bit of a concern when we look at UGG specifically. Again, that's 27% of their revenue, so it's not a huge red flag. But when we look at how much it's ramping into winter, because they are always going to ramp up into winter, it's not doing as much as it did last year. It's actually down on a year-over-year basis, that ramp into winter. And I think a lot of it has to do with, they had some new styles last year in the platform area, and now people still like the product, but it's not this new product. So I think that this winter for UGG boots is going to be down a little bit. I doubt that's not going to come out on the earnings report yet, right? They might have some guidance on that maybe, but I'm talking early indications for next quarter. So on this report, though, everything that we see is pretty strong. The company is performing well. The stock has been sideways. It's a little bit down. So again, I think there's room, but investors are a little weary of the high valuation. They want to see that the growth is continuing. Everything that we've got so far, though, says that the growth is likely continuing, except for UGG in the winter. It's an early call because winter's just kind of getting started, but the enthusiasm at the beginning of the season isn't there. But Hoka is carrying the torch and doing extremely well according to our data.
Landon, this is a popular conversation to have when we talk about Nike and On Holdings and Hoka and Under Armour and all the different shoe companies. Where does Hoka sit? They're pretty popular coming out of the gates, like On Holdings, but are they still a fraction of Nike? Are they catching up? Are they making real headwinds? What does your data say about market share and who's gaining and who's leading?
Yeah, Hoka is the one that's gaining. Of all these brands that Decker owns, Hoka is definitely the one that's gaining. Here you can see the consumer happiness chart. OnCloud has got the happiest customers by far. The rest of them are basically 70%. So, it'd be nice, I think, for Deckers Outdoors to get Hoka and their entire company up higher on this scale. But when you look at, market share and who's gaining, you could break this down by brand, and Hoka is definitely the leader. They're up 48% on a year-over-year basis. That really small brand that I mentioned, I'll try again, Kula Brew. How's that? They're up pretty well, but again, they're tiny. So Hoka's the one you're looking at. Hoka and UGG. Those are the two. UGG, as I mentioned, going into the winter, slowing down. Not the boom winter that they had last year. But I think that the key here is that Hoka's gaining ground on Nike. They got a long way to go, of course, but this is the story that you want to be able to tell investors, is that the brand that represents 2/3 of our revenue, it grew 30% last quarter. Now we're seeing web visits to that and consumer enthusiasm to that up nearly 50% this quarter. So I think this has the potential for a good report. I want to see how much they talk about UGG going into the winter, but I think if they focus on the success of Hoka, that's going to be enough for investors. And given where the stock has been, again, up significantly, almost double ending last year, but sideways since July and selling off even after that blowout earnings where they jumped up and then just slowly over the last couple of months kind of sold off. I think that expectations might be low enough that investors can continue to justify this high PE ratio.
Yeah, and the stock up 36% so far this year. That Kookaburra brand, UGG bought them, so it's Kookaburra by UGG. It's just a cheaper version, but I think maybe your data showed that hey, UGG's down, but Kookaburra's up because people are probably choosing the cheaper version of the UGG boots and slippers at this point. So I think that probably plays into it. But Landon, when you go into earnings on something like this where it's hovering right on its 50-day moving average, it's had a good run over the past couple of years. I mean, even stocks that have done well this earnings season have sold off. What kind of earnings score do you have on this one?
This one's close. So you guys know our threshold is 20. Like that's where we feel pretty comfortable to make a bet. We've actually came in at plus 19 on this one, so we're right there. If it comes down, a little bit more throughout the day, I think you can justify a bet to the upside. Again, it has a lot to do with investor expectations. It's down a little bit, lower into the range when you look at the last 3 months or so, and we see no evidence of a disappointing quarter. I think that there's some early evidence of a potential small disappointment for next quarter, the winter season with UGG boots, but this quarter, the data that's going to be reported on, forget the guidance on the winter, the data that's being reported on, there's nothing scary to us, and I think that there's a likely slight surprise or slight beat for this company going into it. So plus 19 is where we're sitting.
All right, great stuff, great data as always, Landon. Have a great day.